Man, fake outs. So irritating. How can I know to expect one or I'm about to deal with one?
Okay. Well, what's a fake out? Let's begin with that. Like in this case, the fake out you're referring to, the reason why it's irritating, it's because you see a sense of direction. The market goes in that direction, but it goes the opposite way first before going in that direction. Hence the word fake out, right? So in this context, that's what I mean. Okay, there's 3 reasons why fake outs happen. I'm going to explain the first 2 are easy reasons. This is the one that you should focus on. And I'm going to give you a 3rd reason as well because I know you will understand it. Do you need me to do this on a chart or are you able to visualize it if I show it on a whiteboard?
Yeah, whiteboard's fine.
Okay, let me open up the whiteboard here. Okay, so I got the whiteboard up running. Okay, so there's 2 main reasons why fake out can generally happen. One is if you're looking to do a buy, for example, in this particular scenario, let's say you're looking to do a buy there, but it does this before launching. This is generally going to be the case is if you have an overall downtrend that you're dealing with. So that's scenario number 1. You're trying to go against the flow. Okay, so this is a counter trend situation. Okay, even though the read is right, the analysis is right, it's just there's a leftover energy from the big downtrend that you're fighting through. That's why you get that first fake out. The second fake out you can have is news related, especially if the trade actually began from these areas and it launched here. Now this is something, it's a little bit more advanced what we're talking about. This is where the FOMO begins and all orders reside in this area. A news event can actually go down to grab that before it goes back up. So you got to bring a little bit of attention there sometimes, especially if the news event is large enough. Okay, so if it's, for example, an interest rate, inflation news, CPI, PPI, any of these news events can actually create fake outs as well. It can go one way and then it flies the other way. Okay, NFP does this also quite regularly. So these are the 2 main ones. Now, there is a 3rd one also that I would like you to keep track of, and I know you will understand this. 3rd one is correlation related, okay? Now, when it comes to correlation, so let's use an example of Euro, let's say, okay? You're trying to buy Euro USD, and all the Euros are going up. Now, you have a situation where you're trying to do a buy, but you got faked out. This has something to do with the dollar. If the dollar is also telling you that the dollar is strong, in this case, if they're all going up, Euro is showing strength. For this thing to go up smoothly, the dollar needs to be weak, right? But in case the dollar is not weak at that moment, it's strong. Even though it can end up going upwards, it can spike down and drag itself up because the Euro is stronger. I know it's a little bit, it's more advanced, but if this makes sense that when the US dollar is strong, you can get those little energies of US dollar trying to kick in as well that can do that extra spike out. And these fake outs, they really mess up with risk to reward. So you have to be very, very careful with it. The last thing you want to do is widen your stop loss and play it safe. If you play it safe with widening your stop loss, you might as well invest in the stock market and just hope for the best, right? And that's playing it safe. But if you're being a trader, you're putting in the work, the time, the efforts, you want to get paid, your 3 hours, 4 hours, 5 hours, 600%, 1000%, whatever it is, you want to get paid. So these fake outs can become very, very dangerous. Did everything make sense, the 3 different reasons?
There's so many things coming to my head now. I want to dig into my charts and check this out.
Good.